Today, I'll be looking at a detailed plan for retiring before age 60 with $1.5 million using a 57-year-old as an example. Now, over my years helping clients navigate early retirement, I've developed these strategies to make $1.5 million work several years earlier than a traditional retirement. And that's exactly why I'm making this video for you, to show you this plan I've built for a 57-year-old and how this could help you work towards your early retirement goals. So with that, let's get right into it. Let me introduce to you John and Sally, the 57-year-olds of this case study. All right, so here's a snapshot of their situation. You can see high level, and in fact, I'll expand this for you. Most of the income is coming from John's salary, $150,000 a year. However, Sally's working part-time, earning about $2,000 a month, okay? And they're planning to work for the next 3 years and retire in 2028 at age 60. Right? They currently have about $2 million of assets, though a large percentage of that is in John's 401k. They have an after-tax brokerage account, and they own their home. No liabilities. They pay off their credit cards each month. Right? So high level, this is their situation. They were planning to take Social Security at full retirement age, and then obviously want help navigating Roth conversions and required minimum distributions at age 75 down the road to minimize lifetime taxes. So these are some things on their mind. I'm going to come back here and model some different situations. Before I dive into this, I want to show some data from JP Morgan's Guide to Retirement and some data and research that I've done myself and with the help of Asset Dedication to help give context and background of why we're building the plan the way that we're building it. So with that, let's jump to the research. Okay, now we are looking at JP Morgan's Guide to Retirement data. And I will specifically be focusing on the data relevant to the case study of John and Sally, the 57-year-olds, $1.5 million, $175,000 of income. But the beauty of this is that you can see the range of data and apply it to your unique situation. So looking at John and Sally, 175, they need about a 63% income replacement ratio to maintain their standard of living in retirement. So if they're making 175 gross pre-retirement, that means that they could gross about $9,000 a month in retirement and maintain the same standard of living. And when you think about it, that makes sense, right? Because once you're in retirement, you're not saving for retirement, so that's a huge expense that you don't have anymore. Your home's probably paid off, right? That's an expense that you don't have, and you're in a lower tax bracket. So all of these changes in spending, taxes, saving, is why the more income that you have, the lower income replacement rate that you need to maintain that standard of living. Now, from an asset standpoint, this is a really great, just high-level checkpoint. So based on your current income and your current age, like, are you on track to maintain your standard of living at a traditional retirement age, right? So this would be at age 65. Well, John and Sally wanted to retire earlier at age 60, but you can see, so $175,000, if you have $1.5 million by age 65, then you're on track to maintain that standard of living. But obviously, John and Sally want to retire a little bit before age 65, so it's okay that they're ahead of the curve, somewhere between $1 million and $1.2 million. They're actually at 1.5. But because their goals are unique, their traditional retirement, we'll actually look at the software and see what their sustainable spending rate is, assuming they retired at age 60. Or what if they retire today? What would that look like for them? We'll go over that in the software. This is a good visual. I just want to help you see, as you're in your peak earning years, a lot of times you are saving pre-tax 401k to save money on taxes, because as soon as you retired, you're likely going to be in a lower tax bracket where you can pull that money out at a lower tax rate. However, you can see that this gap right here, this block, is a perfect time to consider Roth conversions to smoothen out your tax burden, your lifetime taxes for when later down the road required minimum distributions kick in, and you may be pulling out more money than you need and paying more taxes than necessary, right? And so I'll even show you some Roth conversion planning in John and Sally's case at the end of this video, at the end of the case study, so stay tuned. Now, this is great looking at for those with assets of $1 to $3 million, just looking at their annual average household spending. And you can see that in these early years of retirement, there's definitely an increased spend. But then you get to these later years, maybe you've checked off some of the things in your bucket list, maybe your health isn't good, you're not traveling as much, right? So what expenses are coming increasing in this later stage of retirement? Well, it's your healthcare and charity and giving, charitable giving, whether that's to family or 501c3s or whatever, right? And so they call this the retirement smile, right? So spending more in the go-go years, maybe less in the slow-go years, and then maybe an increase in the no-go years. Let's unpack traditional retirement advice. It can be helpful for rules of thumb, but all models are wrong. Some are useful, something along those lines. But when we look at the 4%, so if you were, let's say you're a DIY retiree and you're just wanting to do the 4% safe withdrawal rule. Well, it's important to know this, that the 4% safe withdrawal rate was based on the worst period to retire, the 1966 retiree, which has to do with sequence of return risk, because the decade following 1966, the 10 years after that, were some really bad market returns early on in retirement. And I have a slide later on, I'll show you that. But here's the thing. So if you just do the 4% withdrawal rate, well, 66% of the time, looking at 68 different 30-year rolling periods, we see that 2/3 of the time retirees actually die with more money than when they started, right? And almost half retirees have twice as much money than when they started. And we have to think, well, how do retirement plans fail? Most people are worried about overspending and running out of money, but dying with too much money is also a way that a plan can fail if that wasn't your goal or your intent. And a common question that I get from retirees is, how should I invest my money? So if we look at this is really interesting, right? And depending on what your initial withdrawal rate and what your asset allocation is, right? All the way from 100% cash to as aggressive as 80% stocks and 20% bonds. Well, you can see if you're only taking out 3% a year, you really don't need to take on investment risk, because you can pay out 3% a year over a 35-year time horizon and not run out of money. But as you start withdrawing more, like 4 or 5%, you need to now introduce some risk into the plan, right? You take on this investment risk to expect returns higher than inflation. You can actually see, this is looking at probabilities of success, or the likelihood of success. And I'm going to talk a little bit deeper about this later in this video too, of what that actually means. But the further right you move along in this asset allocation, so you can see right here, a 4% safe withdrawal rate, you're actually almost in the same ballpark of likelihood of success for all of those asset allocations. So what would be the difference? Well, after a 30-year period, you would expect to have more money in an 80% equity, 20% bond portfolio than you would in a more conservative portfolio. Right? So this isn't necessarily gauging terminal wealth. This is just how many times do you live 35 years and not run out of money, right? That's what this is looking at. So it's a helpful little heat chart. If you've heard of the 4% rule, you've heard of asset allocation, you've probably also heard of the bucket strategy. And I think the bucket strategy is onto something, that it's now incorporating behavioral components into the investment plan, and so dedicating certain assets to time horizons, though I still don't think that this is optimal. I think expanding on this through asset dedication theory and not just asset allocation theory, and building a bond ladder is actually a superior strategy than just the simple bucket strategy. But directionally, I think that this is going in the right place. Right now, we're just addressing retirement risk. So another risk in retirement is your sequence of return risk. And I mentioned this earlier in the video, right? In fact, I'll go there now. You can see the 1966 retiree, if they were in a 40-60 portfolio, the actual annual return of that portfolio was 9.5%, which is pretty high for a 40-60 portfolio. But if they just assumed, if over that same time period, if they assumed a flat 8%, so lower than the actual return of the portfolio, but it was flat instead of volatile, right? They actually had more money at the end of their retirement, or their money lasted them a decade longer. And so you can see, like, this 10 years after 1966, there were a lot of market declines. And as investors are selling their portfolio at these losses, they're locking in, that's the sequence rate of return risk. And you can see, back here that while you're saving for retirement, sequence of return doesn't really matter. It's not really a risk. But as soon as you're navigating retirement, whether the early years of your retirement are good or bad, make a significant difference. So you can see here, the steady rate compared to good early years, bad late years, you have a significantly more money. And then you actually run out of money by having a bad start and a great end, right? So What are we really trying to solve for when we're solving for retirement income needs? Do we really want to solve for the average case scenario? Well, what if you're the 1966 retiree? The problem, you don't really know you're the 1966 retiree until a decade later. And so when we think of financial planning, a more conservative approach is the mini-max approach. Like, how do we optimize the worst case scenario, just so that you can have peace of mind that you'll be okay, right? Instead of thinking of averages. In fact, I'm going to talk a little bit more about this. But in the industry, there's a lot of problems, okay? You could go to 3 different investment advisors and give them the same inputs and get 3 different outputs, right? And that's really sad. Unfortunately, a lot of the industry has developed on the brokerage side, the product sales or insurance side. Not very many people in the industry have a formal education or academic background in financial planning. And the term financial advisor isn't as regulated. It's not a state regulated title like a CPA or attorney is. Literally anyone can call themselves financial advisor, right? So it's like the wild, wild west of financial advice. And like, how do you know, like, I mean, how do you navigate that, right? And that could be a whole video of a whole different thing. But even let's talk about this. So Markowitz, who is the father of modern portfolio theory and asset allocation as we know it. He later came out in 1991 and published a paper that said, hey, like, this actually works better for institutions, not necessarily individuals, right? But Wall Street had already grabbed onto this because it's really easy to assign asset, have someone take a quick risk tolerance questionnaire and then assign them a portfolio like aggressive, conservative, balanced, moderate. And so it became really easy to scale, plug and play. And, from a compliance standpoint, it's like, oh, well, we have this risk tolerance questionnaire and this is the appropriate risk portfolio for our clients. So what was meant to really be used for institutional investing got grabbed onto for individuals just because of the scalability and ease, just because of the ease of scalability for Wall Street. The problem with risk tolerance questionnaires is that they don't really work. And even psychometricians came out and agreed to this, right? They have, and if you think of Titanic, that's a great example. Like, what you think you're going to do in crisis versus what you actually do in crisis are 2 totally different things. Okay, 401ks and target date funds and these one-size-fit-all outcomes. I will say target date funds, I wouldn't say they're necessarily bad. I think they're an okay default. I think there's definitely a better way to invest. I like that a lot of them are low cost and globally diversified and have some tie to a time horizon. However, I mean, let me show you this. So, all right, see, look, this is my problem with a target date fund. So this is a 2065 target date fund, which means you have 40 years for retirement. So why is 10% of the portfolio in bonds? I'm going to get into this later, show you asset dedication when dedicating certain assets to different jobs. Well, fixed income is really good. Bonds are really good at providing fixed income, but right now I would say a 20-year-old with a 40-year time horizon isn't really investing for fixed income in a 401k. They're investing for growth, right? And so, personally, for me, I don't have any bonds in my long-term retirement accounts because stocks are a better instrument for long-term growth than bonds. But once you're in retirement, what's really interesting is that target date funds, even though they're tied to a time horizon as you approach retirement, they're going to be more conservative. The problem is that you don't want to sell your stocks and bonds at the same time. You want to be more strategic about which accounts are holding stocks and which accounts are holding bonds. That is called asset location, and it is a tax efficient way to invest. Plus, you want to be more tactical about which ones you're selling to fund your income needs. Right. So anyways, a little bit of beef there. Plus, again, talking about these questionnaires, literally, this is a 401k plan. And after only 4 questions, like, what age do you plan to retire? What is your investment objective for this account? If you lost 20% in a short period, what would you do? And if you have the choice of the following investments, what would you choose, right? And this goes on to say, like, high risk, high return, low risk, low return, whatever. So after these 4 questions, it kicks out a portfolio. And I kid you not, this is a portfolio that was kicked out for a young person that has decades to go for retirement, and based on how they filled out these 4 questions that they probably don't even fully understand because they didn't learn about this in school. That's a whole nother video, and I'm writing a book called Schooled But Not Educated to help address the financial literacy crisis in our nation. But you can see here that this recommended almost 50% of their allocation in bonds as a young person, right? And again, bonds are not really good for long-term growth. They're phenomenal for fixed income and stability, contractual agreements of income. Bonds are good at that. But over long periods of time, stocks, there's called the equity premium. Over long periods of time, equities or stocks have about a 6% higher return a year than bonds, right? So anyways, just some of the imperfections of the industry, some of the things I'm trying to work on, combat. So is there a better way to invest? And this is where asset dedication comes into play. I'm about to show you a bunch of data, but essentially evidence over time has shown that size and value premiums and profitability emerge. Those 3 premiums tend to outperform over long periods of time. Okay, bonds will be really good for cash flow matching, not necessarily growth. And here I'm making an assumption that what you actually care about is your after-tax spendable dollar, right? How much money what can you actually do with this money? Yes, you care about, yes, investors care about returns, but they don't only care about returns, because really they should be thinking of their after-tax, after-fee, their net return, their spendable dollar, right? That's what I'm getting to. Asset allocation, modern portfolio theory, it's really looking at how do we increase the output of return for the input of standard deviation. It's how do we maximize the risk return ratio, right? Maximizing return for each unit of risk. We don't really think about standard deviation. That's not really what we care about. What we care about is our after-tax spendable dollars. Am I going to be okay? Can I enjoy my time, health, energy, money with the people I want to be with and do the things that I want to do, right? That's what we care about. And that's kind of what Markowitz was saying is hey, this modern portfolio theory, asset allocation, it's really good for institutional investors. It wasn't really meant for individuals. So this is a quilt chart looking at 20 years of data and a bunch of different asset classes. And this data is from Asset Dedication. So thank you, Professor Huxley and Brent Burns, for helping compile this data. What you see in any given year, there is no decipherable, there's no pattern, right? It is so hard to time the market and know which asset is going to be the top performing asset. Look here, in 2006, REITs were the top performing asset. And if you put all your money into REITs in 2006 because they were a top performing asset, well, guess what? In 2007, they were the worst performing asset, right? And you can even see that trend just continued. Emerging market was the best in 2007, but it was the worst in 2008. Long-term government bonds were the highest performing asset in 2008, but they were the worst performing asset in 2009. So anyways, all that to say is it is super hard to predict what is going to be the top performing asset year after year after year. And so when we think of a 1-year time horizon, there's no pattern. Now we're looking at, instead of 1-year data, we're looking at 5-year rolling periods, right? So an annualized return over 5 years. And I'm going to keep going through this data. Okay, so this is 5, this is 10. Okay, by the time we get to 15, holy cow, that's kind of interesting. I'm starting to see some patterns, right? You're seeing red is tending to float to the top and blue is tending to float to the bottom, right? And if we zoom out even more, let's go to 30 or 20 years. Let's go to 30 years. Okay. Wow, at 30 years, we are seeing some clear data, right? Small value over a 30-year rolling period tends to be the top performing asset, right? Back to those premiums we talked about over long periods of time, evidence has shown that value has outperformed growth, that small cap has outperformed large cap, and that profitable companies have outperformed unprofitable companies. You can see commodities are not really a good long-term investment. Treasury bills, not really a good long-term investment. If you're investing for 30 years, right? But the people that argue modern portfolio theory and asset allocation, they would say, well, you should have some commodities in your portfolio because it helps from the standard deviation. It helps from the it helps maximize return per unit of risk. And it's like, well, we don't really care about standard. We don't think about standard deviation as people. We think about after-tax spendable dollars. And so when we think about that, that's why, dedicating certain assets to certain jobs is a more optimal approach for individual investors who want to maximize their retirement income and minimize taxes. All right, but now, so here's another way of looking at that data that I just showed you. When you think of investing for 1 year, well, stocks are not really good investments for a 1 year time horizon because there's a chance that they could be down 37%. And if this is your grocery money, that's a problem. Well, if you look at a 50% stock, 50% bond portfolio in a given year, there's still a chance that they could be down 16%. You think of 2022, where stocks are down 20%, bonds are down 10%. There was no safe part of your portfolio to pull money from. And again, that's why asset dedication is a better retirement income strategy than necessarily just asset allocation. So if you had a 20-year investment time horizon, why would you own anything but stocks? So just things to think about, right? And so for retirees, that really building out a bond portfolio, building out an income ladder, 7 to 15 years makes a lot of sense from an asset dedication standpoint. These are things I've already talked about, right? Individual bonds over bond funds, because bond funds, you're not isolated from interest rate risk, right? You still may have to sell a bond fund when the fund is down, versus an individual bond you can just hold until maturity and know exactly how much cash to expect, okay? I already talked about 2022. Now, if you're thinking that this is a safe part of your portfolio, there are some who want to squeeze as much juice out of their portfolio as you can, which is fine, and so, but there are others who think that, hey, this is the safe part of my portfolio. I want to be as safe as possible. And so they may opt into the U.S. Treasuries that have the explicit backing of the United States government. Right, where others may be more comfortable with U.S. agencies or investment grade corporate bonds. If this is the income side of your portfolio, I wouldn't necessarily go past investment grade bonds to high yield bonds. Another name for high yield bonds is junk bonds, right? They're more risky that you'll get paid the contractual agreement, which is why you can expect a higher return from them. But that's like, what is it for? Is this asset for income and stability, or is it for growth? If you build out a retirement plan this way and you've built out a dedicated portfolio, then as you have the bond ladder, the income ladder, each year we're looking at the critical path, we're looking at the danger zone and the safety zone, and do we use the cash from the maturing bond to fund your cash flow liability, or maybe the market's been really good and we can trim some equity. You're in the safety zone and we can trim equities and use that money to fund your cash flow liability, and then use the maturing cash from the bond to buy the next rung of the bond ladder, right? So and that way it's an art of rebalancing, but by having the bond market, that's why you've created this time segmentation where you can weather a stock market storm because you're not needing that money for 7 years, right? 7 to 15 years, because you've already taken care of those needs. This is interesting. I've shared this before in other videos, but psychologically, retirees that have guaranteed income are more likely to spend money in retirement versus those who otherwise could spend the similar amount, but they're letting fear lessen their spending. Right, so having these contractual agreements in a bond ladder, or maybe it's Social Security, maybe it's a pension, maybe it's annuity, whatever it is, but having these guaranteed income can psychologically help us enjoy the money we've worked so hard to earn and save. Right, so again, what is it all for? And when you think about planning for retirement income, it's really helpful to, some of you want to maximize optionality, and some of you would prefer a committed approach to retirement income and protect yourself from cognitive decline, protecting you and your assets from future decisions where you may be experiencing cognitive decline. Other of you want to maximize optionality and leave the door open to pivot based on changing circumstances and preferences. Some of you are okay with the probability-based approach to retirement income planning, where some of you would rather lock it in and have it, that safety first guaranteed approach to retirement income planning. So on my website, I actually have Yeah, on my website under the resources tab, I actually have right here the retirement income style awareness. You guys can click on here and do this assessment for free of charge. It normally costs $35, but you can do it to figure out what your unique preferences are. Okay. Back to JP Morgan's research. This is really interesting. So consider how to fund your retirement goals, right? Well, some people, I really work with people in two different camps. Yeah. So in one camp, I have people who won't spend money and they're accumulating more money. And I have to tell them, look, if you're not flying first class, your kids will be. And in the other camp of people, they are telling me, Thomas, if we don't overdraft our last check, we miscalculated, right? And so it's important, again, back to RISA, retirement income style awareness, understand your unique preferences, goals, concerns. Back to probability of success, here's my beef with it and why I'm a bigger fan of asset dedication theory and income guardrails is because, when we think of Monte Carlo analysis and we're thinking of these 1,000 simulations based off expected returns and, everything that we know and would expect. Well, what is the best answer? The best guess, right, would be that median approach. It's like, hey, that is our best thinking of what could happen. But that's actually, from a financial planning standpoint, how do you have 100% success is actually by being over here, the most conservative, right? And so another way of saying 100% success or not running out of money means that we're accepting this predicted underspending, right? And so what we see in practice is that, and again, I've talked about this already, the risk of overspending, but in retirement, there's two types of plan failure. You have the risk of overspending, but you also have the risk of underspending. And so what we see is this risk buffer here, and a lot of advisors are targeting this spending level here, where there is still some probability of overspending, but we're not so conservative that we have a 100% chance of underspending, right? And the thing about this isn't a set it and forget it strategy. Like, this is where dynamic income guardrails come into play and are so helpful, that you make the adjustments throughout the years when the markets are good and you have a higher probability of underspending, then let's increase your spending. Right? And if the markets are really bad and now all of a sudden you have a higher risk of overspending, well, maybe let's cut back a little bit. And as we make these dynamic adjustments to your plan, it just leads to more optimal outcomes. And you can see here, like that 4% rule, and just increase it every single year in inflation and never think about it. That would be like that red line, versus an age-based approach to spending that says, hey, maybe let's actually spend a little bit more money in these go-go years where we have the health and the energy to do it. And later, we may be spending less down the road, but I'm okay with that because maybe I'm in a long-term care facility and I don't have the health and energy to enjoy this money anyways, right? This right here would be the regret zone. If you didn't follow this plan, this could be the spending, the blue above the red right here in the go-go years. Some refer to this as the regret zone, right? The money that you could have spent while you had the time, health, energy to enjoy it, right? So just food for thought. Now, again, I don't want to lose sight of John and Sally, our 57-year-olds, and their decision of navigating retirement. So we've talked extensively about how to invest their assets and withdrawal rates, and we're going to go see in the software exactly what their unique withdrawal rate is. And we've talked about how to invest, and we've talked about asset allocation versus asset dedication. We've talked about how tax efficiency, asset location makes a big difference when you're thinking about your after-tax spendable dollar, and that you really probably aren't thinking about standard deviation, and that risk tolerance questionnaires don't really work. And anyways, we've talked all about investing, and which the investment plan of a retirement portfolio is a central part of the plan, right? So it's okay that we spend a lot of time there. But also, again, thinking of John and Sally, they want to know when to take Social Security. They were planning at full retirement age. Well, here's a really interesting chart. Well, if you claim Social Security at age 62 versus full retirement age versus 70, you can see if you live to age 90, it can be hundreds of thousands of dollars difference in benefit. Right, and I want to highlight this. Social Security, before the one big beautiful bill Social Security was already a tax efficient income source, right? Because even for the highest income earners, 15% of your Social Security was still tax-free, right? So you want to maximize tax-efficient income streams in retirement, especially if you have longevity. Now with the one big beautiful bill, for a lot of people, they may be, Social Security is going to be even more tax-efficient income source for them, right? So it makes sense to optimize your tax-efficient income sources. But this is, thinking about your longevity is helpful. And in this case, right, in this scenario from JP Morgan, claim at age 62, well, the break even compared to claiming it at full retirement age was about 15 years to age 77, where total assets, total income collected, cross pass. And then from full retirement age to age 70, it was about age 81, about 11 years, where the total income collected, the break even. There is an argument, like if you think you're only going to live to 80 years, well, yeah, like I understand the argument of why you'd want to claim Social Security early to enjoy that benefit longer. But when you have a couple, you can't just think of your life expectancy. You also have to think of the household, right? Because the higher, like in John and Sally's case, John has a higher Social Security benefit, but at his passing, Sally will assume his higher benefit, right? So those are things that we're going to look at. I'll show you exactly. Now, you also can't navigate early retirement without talking about healthcare. There are ways to navigate the healthcare marketplace before age 65 Medicare, and I rely a lot on Move Health, who are the healthcare experts around the nation. We do income planning for you to look at premium tax credits and see if we can get you subsidized healthcare from the government based on your income, right? But once you're age 65, this is helpful, right? Like the month before the month you turn age 65, you should enroll into Medicare Part A unless your employer has creditable coverage, right? Which creditable coverage essentially just means it's as good as Medicare and not costing you a lot more. Right, but it is good to know. Supplemental plans don't include vision, dental, and hearing, which is why Medicare Advantage plans are popular and sold. But the biggest constraint or limitation to Advantage plans is that you are limited to a network of providers, whereas with Original Medicare, you're accepted by all Medicare providers, right? So this is helpful when we're planning your income in retirement. We're thinking of Roth conversions. We're thinking that you may have heard of income-related monthly adjustment amounts. A lot of people call this IRMA, which are the premiums of your Medicare Part B and D will cost more at higher income levels, right? So once you cross the IRMA threshold, and this is a 2-year look back. So in 2025, if you had a 2023 tax filing, modified adjusted gross income between $212,000, $266,000, you were paying an extra $87,000 a month for parts B and D, right? You can see that it can get pretty expensive. Ultimately it can cost you thousands of dollars a year if we're not being intentional with our tax planning. Okay, long-term care. This is really interesting. So of those who needed paid care, age 65 and older, how long were they in facilities? Well, you can see the majority, over 50% of people are in there less than 5 years, right? But there's still a substantial amount of people who are in these facilities for greater than 5 years. And when we go to average cost, you can see, declining trend until, bam, over 300,000. There's a significant portion of people who are in these facilities for a long time. That's why you see the average for women, $332,000, the average for men, $240,000. Let's dive back into John and Sally. Let's look at their case. All right, so we're back to John and Sally. Now let's look at their unique plan. With all the data that we considered, let's actually look at this. So if we go to their dashboard, okay, you can see that their current spending capacity is about $7,730 a month. Now, it is important to note that this is after-tax spendable dollars, right, net. And if we go to gross, you can see they're just about at the $9,000 gross that we had seen from the JP Morgan Guide to Retirement, the 63% income replacement ratio. So they're just about there. So if we go again, but clients care about after-tax spendable dollars. So they're right on pace to replace their income. They're on pace, even retiring at age 60. This is showing a retirement at age 60 at 2028. And we're even showing here, if we go here, cash flows, this is showing that flat adjustment, like how much could you spend and continue to spend for the rest of your life with inflation. So let's go ahead and make a change. Let's actually income path, let's say, hey, let's actually look at an age-based approach where they can spend a little bit more in the early years of retirement. And if we come back here, now their spending, their after-tax spendable dollar has jumped up. They can spend a little bit more today. Looking at this, you can see that while they're working, their gross income is higher, but they can maintain that same standard of life at a lower income amount because of the taxes, and they're not saving for retirement anymore, right? And in fact, what if we did this? This is where it gets really interesting, and we can say, hey, John and Sally, if you're okay spending $7,000 a month, there's a world where you can retire today, 3 years earlier than you thought, right? And if this isn't, based on their unique spending needs, if this isn't enough, well, they have options, right? They can work a little bit longer. They can save a little bit more money right now. Or they can decide to work part-time in retirement, and maybe instead of going from 100 to 0, they just dial back gradually and do maybe part-time consulting, but now it's on their terms and they're supplementing their income, maybe in something they're more passionate about and on their terms, still maximizing autonomy. There's a couple of different things that they could do to get where they want to go, and it can look different for everybody. But, this is where the income guardrails come in. So it's like, hey, what if markets do really good and your probability of underspending increases? Well, then let's increase your income to $7,860 a month instead of hey, let's bump your spending, your monthly spending. But if markets go bad and, this income guardrail recross that path and the probability of overspending increases, then it's like, hey, we may need to cut back a little bit to help you. And really, you can see this. I think this is a great visual. Maybe you want to be more conservative and you want lower spending, but a lower chance of adjustment. Well, you can do that. All right. So just things to think about. Let's look at Social Security. So how, quickly, this is a great heat map as well to see how can they maximize their Social Security benefits. We can see this heat map of when, how to maximize their Social Security benefits based on their life expectancies, right? And this is saying, hey, each of them delaying to 70 maximizes their lifetime benefits, right? But what I know about Sally is that, in fact, here, where is it? Right here. Right, so this is still 98% of the max benefits, but she's turning on her benefits 3 years earlier at full retirement age. I think that this is more optimal for them, is that John delays to age 70. He has the primary benefit. If he were to pass away, Sally can assume his higher benefit. But Sally's spousal benefit, half of John's benefit, is higher than her primary benefit. And so there's no reason for her to delay her primary benefit if she's going to claim the spousal benefit as soon as John turns his Social Security on. And so I would say claim your full retirement benefit, Sally, at age 67. Collect income for 3 years while you're waiting for the spousal benefit. The reason I would say don't draw Social Security before age 67 is because you will actually lower the amount you're getting from your spousal benefit if you claim your Social Security benefits early. Here, looking at, again, Roth conversions. What's the optimal Roth conversion strategy? Well, this is looking at a bunch of different distribution strategies and Roth conversion strategies, looking at IRMA brackets, looking at filling up certain tax brackets, and we can view the tax strategy heat map, and we can actually find, the one that it starts. So in their situation, doing Roth conversions to fill the 12% tax bracket is actually what lowers their average tax rate and total taxes over their lifetime, right? So it's a huge bonus and strategy for them, which could save them $500,000 of taxes over their lifetime. Now, to be fair, this does assume they live long life expectancy, where a lot of these tax savings come, because the break even on this isn't for 2 more decades. So it takes a while for the Roth conversion strategy to pay off. But if you're going to live to full life expectancy, or you have heirs that have another 10 years when they inherit this money for this money to grow tax-free, then that's really where these Roth conversion strategies can make a lot of sense. So now if we go back to the dashboard, let's update their plan. Let's say, hey, so on Social Security, we actually found that it was optimal for John to delay. We're going to keep Sally at age 67. We're going to finish that. They came to me thinking they wanted to retire at age 60, and now, after this, we've found there's a world where you can retire today and sustain $7,000 of after-tax spendable dollars, where we can build a plan for you. And once you know this, what their spending capacity is, and even if we're on that age-based approach, like now we can build a bond ladder for this and guarantee these cash flow income. Now that you know how to implement a retirement plan for retiring before 60 with $1.5 million, you can use this information to make more educated decisions when it comes to your retirement. And if you'd like a free personalized review of your exact situation, click the link in the description below. I'll see you in the next one.